You know, the global oil market, it's this massive $2 trillion engine that runs our world. But here's the thing, it's also wildly chaotic and pretty much impossible to predict. So what if you could predict that chaos? Not with the old school economic models, but with a new kind of AI that learns to read the news, literally reading the fear, the hype, and the stories that actually move the market. So let's dive in and start our investigation.
So think of this like we're investigating a crime scene. The culprit? These wild swings in oil prices that have cost companies and even entire countries trillions of dollars over the decades. The traditional tools, our old detectives, they've completely failed to predict the biggest shocks. So we need a modern detective to figure out what's really going on here.
All right, and here it is. This is our target. This chart shows what's called realized volatility, which is just a fancy way of saying how crazy and unpredictable oil prices have been for the last 40 years. It's just a mess of spikes, right? And each one of those peaks represents a moment of huge financial risk, a crisis, a war, a panic. And that giant off-the-chart spike in 2020, yeah, that's our smoking gun right there.
Okay, now this is where it gets really interesting, because here's the evidence of failure. That gray line, that's the huge volatility spike from the pandemic. And those dashed blue and green lines, well, that's what the so-called standard industry models predicted. I mean, they didn't just miss it by a little. They were totally blind. They predicted a little bump while the world was going through a financial earthquake.
So this brings us to the big question, the real mystery here. Why? Why do our best, most sophisticated financial models just completely fall apart right when we need them the most? What crucial clues are they missing?
Okay, so our first clue, and it's a huge one. It turns out that markets aren't just these cold, calculating machines processing data. Nope, they're run by people. And what drives people? Emotions, stories, and yeah, a whole lot of fear about what might happen next.
In this chart, it shows that perfectly. The yellow line, that's tracking geopolitical threats. You know, the news, the rumors, all that fear. The red line, that's the actual stuff happening. And just look at it. The yellow spikes of fear are almost always higher, and they show up earlier than the red spikes of reality. It's wild. The market is trading on the scary story long before the facts even come in.
And believe it or not, this idea actually has a name. It's called narrative economics. And the theory is pretty simple. The stories we tell each other, the narratives that go viral on the news, they aren't just background noise. They are incredibly powerful economic forces that dictate how we behave and, in turn, how the market behaves.
All right, on to our second clue, and this is where things get even crazier. It's not just that the players in the game are emotional, it's that the actual rules of the game can change, like right in the middle of a play.
So in statistics, they call this a structural break. It sounds complicated, but the idea is actually super simple. Imagine you're playing a board game. You know all the rules, and then you wake up one morning and the rules have totally changed. Everything you knew, all your old strategies, they're completely useless now. That's exactly what a structural break does to an economic model.
And here is the visual proof. It's undeniable. On the left, during the 2014 Shale Revolution, the relationship between geopolitical risk, that's the GPR index, and oil volatility just broke. It flipped from positive to negative. Then, on the right, during the COVID crash, the link between overall market fear, that's the famous VIX index, and oil volatility went from being basically flat to just exploding upwards. The old rulebook was thrown right out the window.
And look, this isn't just us eyeballing a chart and saying it looks different. This is statistically proven, using a tool called the Chow test. It's designed specifically to find these breaks. Well, the results for both events came back with a p-value of less than 0.001. In the world of statistics, that's like a blaring siren telling you, hey, this is real. This isn't random chance.
So, this is the key takeaway. This is why those old models fail so spectacularly. They're built on one single, fatal assumption, that the rules are fixed. They just can't handle it when the game itself changes.
Okay, so let's recap the case file. We've got two major clues. 1, markets are driven by emotional stories. 2, the fundamental rules can change in a heartbeat. This is not a job for your standard economist with a spreadsheet. No, this calls for a new kind of detective, an AI detective.
And here it is. Let me introduce you to OVIP, the Oil Volatility Intelligence Platform. And trust me, this is not just another boring prediction model. This is an intelligence system built from the ground up to understand exactly those two clues we just uncovered.
So how does this AI detective actually crack the case? Well, it follows this really smart three-step process. First, it figures out the market's mood. Are we calm or are we in a full-blown crisis? Second, it does something no traditional model can do. It reads the news. It analyzes the narrative by going through more than 45,000 headlines to get the real sentiment. And then, only then, does it make its critical prediction. Is volatility about to go up?
And I gotta tell you, that first step, figuring out if the market is calm or in a crisis, is absolutely critical. Just look at this quote from the research. A piece of bad news during a calm period, it barely makes a ripple. But that exact same news during a crisis, it can be 14 times more powerful. See? Context is everything, and this AI gets it.
Okay, so an AI that can read the news and predict market chaos is, well, it's really cool. But what does it actually mean? How does solving this case create real-world value?
Let's get right to the bottom line. When they tested this model on data it had never seen before, OVIP correctly predicted the direction of a future volatility spike 69.1% of the time. Now, in a market that is famous for being random, that level of accuracy is it's extraordinary.
And that kind of accuracy lets you make way smarter decisions. Think about it. The old school, naive way to manage risk is just you hedge a fixed amount all the time. It's clumsy and expensive. But the OVIP-informed strategy, it's adaptive, it's smart. It tells you, hey, a crisis is brewing, hedge more now. And then it tells you, okay, coast is clear, you can save your money. It's hedging risk when it's high and saving money when it's low.
And the financial payoff for being that smart? It's huge. A simulation showed that over 5 years, this AI-driven strategy would have delivered an extra 2.46% in returns compared to the old way. In the finance world, they call that alpha. It's basically pure profit that you get from having a better strategy, not just from luck.
Now, 2.5% might not sound like a life-changing number, but let's put it in perspective. For a huge company, like a major airline that has to buy tons and tons of fuel, that 2.46% translates into tens of millions of dollars. Real money. We're talking about a massive competitive advantage here.
So, we started this whole investigation with a chaotic market, a real mystery that the old tools just couldn't solve. And the solution, it turns out, was an AI that could finally understand the two things that really move markets: human stories and sudden, game-changing shifts. So that brings us to one final, big question. If AI can now master the complex, emotional story of global finance, what other story will it learn to read next?